All right, everybody, welcome back to Map Money. Today we're going to talk about a very, I don't want to say sensitive topic for the channel, but it's definitely a question I get very often. And I think as people have watched the channel grow over the past 5 years, they've noticed changes. And so therefore they ask questions, right? Whether that's because they haven't necessarily grown in the way that I have, or just because my mental objectives for the portfolio and my investments have changed. While theirs are kind of staying and remaining the same. And it's not to say that anybody is right or wrong in the way that they're doing it, but it's just an observation that people have. And so they leave comments. And so I want to give everyone kind of a quick update as to why over the past 2 or 3 years, my portfolio has changed pretty drastically. And so in order to answer that question, I have to take probably 30,000 steps back. I started investing in 2012 timeframe. It's the only time I really started to make money in life. Yes, I had some money, here and there when I worked weekend jobs, being like a kennel assistant, and then, doing stuff at a rehab hospital, physical rehab hospital, doing some stuff there, being a physical therapy aide. And then eventually I started going to school for engineering. And in 2012 is when I really got my first engineering job. And so with that, was when real money started really coming in, right? That internship paid pretty significant. It was probably the most money that I'd ever made in a single month. And with that, it allowed me to kind of understand, what my life was going to be like as an engineer, and how I would have to kind of invest my money to get to where I want to be in life, whether that was just retiring early or just provide flexibility or what have you. So with that, I started trying to understand how to invest. So nobody really taught me how to invest early on, and I didn't have people like PPC Ian or folks early on in those days. Actually, the only person I really started to see was in like 2015, 2016 timeframe, which was Dividend Mantra, Jason Fiber. And he has a pretty decent YouTube channel now as well. So I'd recommend you guys checking him out. But it was really just trial and error. And so going from penny stocks to then eventually high growth stocks to then understanding, dividends, and that kind of coupling that, the dividend era of my portfolio with the job insecurity that I had at the time, because I work in a very cyclical business, oil and gas. I saw people getting laid off left and right. And so it kind of nailed into my memory and my mind that I needed security. And with that security, it was dividends and anything I could do to bring in an income in the event that I lost my job. And so that for the next, I would say 5 or 6 years, was my MO for my investment portfolio. I had found my objective. One of the 5 things that we always talk about, right? The objective, time horizon, risk tolerance, all that. And so I had found my objective, and my time horizon was today, right? Like as much dividend income as I could get today in the event that I unfortunately lose my job. So I didn't know how long a downturn was going to last on the oil and gas industry. And since then, I've unfortunately seen 3 massive rounds of layoffs with small layoffs in between. And so with that, it really structured my investment portfolio. It wasn't really until the point where 2020 came in and my portfolio really expanded pretty rapidly, and then continued into 2021, where I started to recognize that if I needed the dividends, they would always be there. What I mean by that is I sacrificed short-term growth and potentially long-term growth with the fact that I needed the stability with income, without recognizing that it's likely better to have a very well-balanced portfolio, not leaning one way or the other too extravagantly, because that introduces volatility, that introduces underperformance, in my opinion. Volatility if you go the super growth route, and underperformance if you go the super dividend heavy route. Where in the 2015 to 2019 time period, I was very focused on high yielding companies, not dividend growth companies, but high yielding companies that were paying 6%, 7%. And generally speaking, those kind of companies underperform the market. Not all of them, but majority of them. You're sacrificing the company's maturity for long-term growth, and they're more so focusing on dividend payment and buybacks and stuff of the like than reinvesting into the business. So I'd underperformed massively. I had a huge amount of money in my oil stocks because I paid such great dividends, and I would underperform. And you could look over the past 10 years, oil stocks have not been massive growers in terms of the principal amount. Yes, you were able to get some dividends, but at the end of the day, you would have underperformed the market comparatively to the S&P 500. And so I got to the point where the portfolio grew to almost $500,000, let's just say. And if I needed the dividends, 6%, 7%, I could move it over and be able to attain that. And so my thought process was, why am I chasing the yield when I could have a better balanced portfolio? It's likely to be less volatile. It's going to be invested in great long-term companies that potentially get switched out for me every year or however often they move companies in and out of, say, the S&P 500. And it'll be great for me long-term. And in the event that I needed that money, I could switch it over. And I also recognize that if I were to retire early, I wouldn't just retire here in Houston and then immediately go back to Pennsylvania and just live a life. It's if I were to retire early, I would probably take a pretty good couple years traveling and living in Asia or South America and doing that whole thing, the nomad life, for a couple years before I finally settle back down. And so while I might have kind of a place of stay in the United States and pay, a small amount of rent, whether that's for storage or for, living with somebody, I wouldn't need the full-time retirement income of, say, $80,000 or whatever just to live comfortably, as well as have some excess income in case of necessities. I would need something more in the lines of $24,000 to $36,000 a year, with a couple $1,000s every quarter or so to be able to fly myself to different places. And so my thought process is if I could keep my income around $24,000 a year from dividends, coupled with some other sources, whether that's from options, whether that's from the YouTube channel, whether that's from being able to get sponsorships, or as well as this trading and doing some side work for folks, then in all honesty, I have as much money as I need. So why am I continuing to focus on dividend income, which would allow me to most likely underperform the market, when I could focus on getting to higher and greater things, really making a step change? I could be making $36,000 a year or $48,000 a year. It's not going to really step change my lifestyle. And so my thought process was, really, I need to invest in order to step change my lifestyle. I need to invest as if my expenses are going to increase in the long term, which they will likely. I'll end up potentially starting a family, or I might end up wanting to have a more expensive lifestyle, or what have you. Just life in general gets more expensive with inflation, as we know. And so my thought process was, instead of focusing on underperformance and these 5 to 6% dividend yielders, I'll focus on the balanced approach, invest in something like an S&P 500. Now, that's not to say what you're doing is wrong, but what I do see is a lot of people falling into the same trap that I did, where you could follow that path for 4 to 5 years. You recognize you'll end up getting more dividends than you ever thought you would. And it gets to a point where you're like, I'm not using these dividends and I'm underperforming the market. A lot of companies, for some reason, get targeted. They cut the dividend, and next thing you know, their price gets cut by 30% as well. And so then you end up in this situation where you underperform the market. You're no longer getting the dividends. And so it's almost better to focus on a company that, or an ETF that focuses on a balanced approach of giving you a little bit of drip and also coupling that with a little bit of principal appreciation. And if you're a dividend growth investor, you're looking for the 2.5% to 3.5% yielding companies that are steadily raising it slowly every year, and they're not focusing on getting it to a 6% or 7% yield, then those companies are a lot better for the long-term appreciation. And those are the companies that people write about when they're talking about dividend-paying stocks pay better than non-dividend payers, yada, 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 because they're doing a little bit and exercising a lot more discipline. whereas those 5 to 6% yielders, generally speaking, are not. And I think that that's where a lot of people get caught up in, because you're able to understand. And, you know, it's almost like it's not a competition, it's a community, these dividend people that are all about PADI, passive income dividend, passive annual dividend income, PADI. And they're always like, you know, 2,000 a year or 3,000 a year or 10,000 a year. And it's like it's not a competition, but it's like a unwritten competition where everyone's trying to grow their PADI to get the attention from others, to try to get themselves belonging to the community. When in reality, you know, they need to focus on themselves. They need to focus on what's important for them. And I think my story, at least hopefully for you guys, demonstrates the maturity aspect of being retrospective about your portfolio, where you need to be in your portfolio, and consistently recognizing as your portfolio has grown. I started, you know, 10 years ago with, you know, basically $0. So starting at zero and getting to $750,000, million plus, you have to change your strategy. You have to do things. Warren Buffett's not going to invest the same as he does today as he did back in 1968. And you have to understand that as you mature, as your portfolio matures, as your objectives change, as your time horizon changes, as your risk tolerance changes, that means you're not going to be investing the same way. And so I hope you guys recognize that as your portfolio grows, it takes a lot more to move the needle. And, you know, $24,000 a year in dividend income or $30,000 doesn't really tickle my fancy, right? I could have literally, and I've seen it, $30,000, $40,000 up days or down days. Well, I haven't seen $30,000, $40,000 up days. I've seen $20,000 up days, but I have seen $30,000, $40,000 down days. And so you just literally had, I'm not saying it goes against the dividend aspect of things, but I'm just sharing with you, when you get to a portfolio size that's pretty significant, you know, $30,000, $40,000 isn't a lot. And so I'm not rooting against dividend income. Hell, if you're someone that's a retiree, you know, I understand where you're coming from. If you're also just getting started, you need to get your feet wet, I think it's good. But once you've gotten your feet wet and you've gotten your mentality into it, meaning you're saving every month, you're investing every single month, I encourage you to reach out to me, reach out to anybody. I offer free advice. I have a free WhatsApp group you can join. It's not always about dividends, man. And while it's nice and it's easy to look at, okay, if I invest $10,000, you know, I'm going to get $300 a year in dividend income. It's like, I've been there. But at the end of the day, you have to recognize what you're really doing it for. Are you doing it for dividend income today? Do you need that $300 a year today? Or are you looking to get $500, $600 in 20, 30 years? And so that might help you understand, you know, the delayed gratification aspect of things. And so I think people run in this hamster wheel and think that they're doing things because they're in this community or a community that shows them a way. But, you know, just because there's a community that is, let's just say, day trading, and you sense the community, you want to be a part of a community, doesn't mean you're going to start day trading. And unfortunately, I see that a lot as well. People seeing a community and anticipating, and that might be the first community they get involved in. So they try day trading and they lose a lot of money. And it's like, well, why do you think you could day trade? Well, I saw a lot of other people doing it, but, you know, it's just like, well, a lot of those people claim they can do it. And a lot of those people also might not have jobs. A lot of those people might have a lot more free time in their hands. And so they have 4 or 5 hours a day. You have 5 minutes between meetings. You're not going to be able to day trade, right? And that, I saw that very early on in my career. You know, swing trading might be something a little bit different, but you have to recognize and be honest with yourself. And that's what I think my portfolio shape is looking like more now. If I see a great opportunity, you know, I see Pepsi go back down to the hundreds, you know, maybe I'll buy more. But it gets to the point where you're kind of just saying, well, the S&P is pretty good. It's looking pretty good. Let me put money into that. Or I think this caterpillar has outlived its life, right? $220, $230 a share, it's probably worthwhile to sell, put that money into the S&P 500, don't worry about it again. Because you have these ebbs and flows in the market, and if you can understand them, right, when interest rates rise, it's better to invest in these companies. When commodity prices go through the roof, it's better to invest in these companies. When you're at the end of a business cycle, do you honestly want to keep track of all those things? Or would you rather be something that you continue to invest in and just have confidence in and not have to worry about it in the long term? And you're going to perform as the market would by investing in, say, the S&P 500. So I recognize that some of you also might be focusing on lower volatility, not losing money. And so you might be focusing on something like a consumer staple, but I've seen Pepsi drop 20%. I've seen, not in a day, but over the course of several months, I've seen J&J do the same. I've seen Realty Income do the same. So just because you're investing in a dividend company, yes, it might have a lower beta than, say, the S&P 500, because obviously that's what the beta is written off of. But I just encourage you to think a little bit differently and reach out to folks and honestly think about what your portfolio is there for and what your objectives are. And God forbid, if you're going to be investing for the next year and you need this money in a year, do not invest in the stock market. I've had so many people say, I have a home equity line. I want to buy something in a year. What should I do with my home equity line? And I'm like, just don't do it, man. And I've seen so many people. And I've had people over the course of 2020, 2021 reach out to me and say, oh, like, XYZ. And I tell them, dude, put that money back where it belongs. And then I make videos about it. I say something like I just did. And they'll message me like, you don't know the situation and yada, yada, yada. And they get all defensive. And it's like, well, probably because that person lost money. So I got a lot of grief from a lot of people that selectively listen to the words that I say and take things out of context and then try to throw them back at myself. Like I told them to invest 100% of their portfolio in a specific position or something like it. I've never encouraged that. The only company or ETF I encourage that for is probably the S&P 500. And I tell people majority of the time, no more than 5%. But they like to throw risk management out the window and selectively listen. But anyway, I hope with this video you take the opportunity to listen a little bit, think about how some of these things might apply to your own portfolio. And I'm not saying switch from a dividend investor to a growth investor or a balanced investor or the S&P 500. You have to recognize what's right for you. And my hope is that this perspective or my perspective and my journey going from zero to wherever I'm at today, because I don't really share that too much anymore, it gives you an idea as to, I started at zero and now I'm at 250K. Am I still doing what I did at day one? Maybe I should switch it up, right? So just helping you encourage and trying to teach you guys a little bit to fish. And not to say that I'm a guru of any sorts, but yeah, hopefully that helps. So I'll talk to you guys on the next one. Cheers.